All right, strap in everyone, because today we're going to take a deep dive into the world of angel investing.
Sounds exciting.
Yeah, we're going to try to decode the playbook of this guy, Matt Wilson, who's a pretty seasoned investor. We're going to try to figure out what makes him tick, what makes him successful.
Okay. Yeah.
You share some sources with me, and it looks like having a rock-solid investment thesis is a key part of his strategy.
It really is. Think of it like a compass.
Okay.
It guides you through the chaotic world of startups, helps you make smart choices and avoid those shiny object distractions.
Right, right. So beyond just a fancy buzzword, what's the real power of having a thesis?
Well, it's all about focus. A strong thesis forces you to define your sweet spot.
Okay.
The types of companies, industries, and stages where you really have an edge. Matt, for example, really laser focuses on seed stage software startups.
Okay, so why that? Why those in particular?
He spent his entire career in software, so he understands the landscape, the risks, and the potential rewards probably better than anyone.
So it's about playing to your strengths.
Exactly.
Got it. But, wouldn't you want to diversify? Try different things.
Fine.
Why limit yourself to one specific area like that?
Well, think about it this way. At the seed stage, you're betting on raw potential.
Okay.
The company might just have what they call a minimum viable product or MVP, and maybe a handful of early customers.
Uh-huh.
It's very high risk, but the payoff can be astronomical if you pick the right horse.
Okay, so high risk, high reward. But why not go for, the later stage companies?
Right.
The ones that are already a bit more established. Isn't that a safer bet?
Well, it might seem that way, but later stage companies come with higher valuations and often way more competition.
Right.
Remember the power law.
Okay.
Only a small handful of investments will drive the majority of your returns.
Right.
So Matt's looking for those potential 100x companies, and that often means getting in on the ground floor.
Okay, that makes sense. So step one is to define your area of expertise and the stage that you're comfortable with. What about location? Does that actually matter?
Oh, absolutely.
Okay.
Matt Wilson really sticks to North America.
Okay.
He's got these really deep networks there. He understands the regulations, and he can offer more than just capital to the companies that he backs.
Right.
It's like having a home field advantage.
Yeah, being local gives you an edge, for sure.
Yeah.
Does this mean investors completely avoid emerging markets, though?
Right.
Would there be incredible opportunities there?
There definitely are, but they come with a whole different set of challenges.
Uh-huh.
Regulatory uncertainty, political risks, and it's even difficult to do due diligence sometimes. Some investors specialize in that, but it's not for everyone.
Right, so it's about knowing your limits and really sticking to your strengths.
Right.
So we've got expertise, stage, location. What's next?
All right, now we get to the exciting part, the return profile. Matt's very clear that he wants venture scale returns. That basically means he's aiming for those companies that could potentially become the next unicorn.
Right.
The next billion-dollar company.
Okay, but how do you actually spot those companies? Aren't there tons of startups claiming to be the next big thing?
Yeah, there's a lot of noise. It's all about separating the signal from the noise. Matt looks for companies that have at least an MVP
Uh-huh.
and are generating some revenue already. He wants to see traction, evidence that they're solving a real problem,
Okay.
a problem people are actually willing to pay to solve.
I see. So it's not just about, a cool idea on a pitch deck.
Right.
There needs to be some substance.
Right.
Some proof of concept.
Exactly. And speaking of pitch decks, there's this other insider term Matt emphasizes, pro rata rights.
Okay, that sounds intimidating. Break that down for us.
Pro rata rights give the investor the option to keep their ownership percentage as the company raises future rounds of funding.
Okay, so if the company's killing it, you get to stay on board.
Exactly. And reap bigger rewards.
Okay, yeah, that makes sense.
Here's where it gets interesting, though.
Well,
While not having pro rata rights isn't always a deal breaker, Matt says it can be a red flag.
a red flag.
Yeah, if a founder is completely opposed to them.
Okay, so why would a founder not want to give an investor those rights?
Well, it could be a sign that they aren't fully committed to their early investors, or maybe that they're a bit overly focused on maintaining control.
Oh, so it's something to watch out for.
Yeah, it is.
So it's not just about the numbers, it's about the founder's mindset and how they view their relationship with their investor.
Exactly. Now, let's take a step back and look at how all these pieces fit together
Okay.
to form Matt Wilson's final investment thesis.
Okay, let's see the master plan in action.
He's essentially looking for post-product revenue seed stage enterprise or consumer software companies in North America
Okay.
with a maximum post-money valuation of $25 million. And yes, those pro rata rights.
Wow. Okay, that's very specific.
It is, yeah. But each element acts as a filter
Right.
to help him quickly screen potential investments.
Okay, so it's like he's got a checklist
He does,
to
yeah.
weed out the companies that don't align with his vision.
Exactly.
But how does this actually play out in the real world? Let's say, like, you're Matt Wilson and you've got a stack of pitch decks in front of you.
Right.
What happens next?
Well, first he'd look at the company's location. If it's not in North America,
Yeah.
automatic pass.
Location, check. What's next?
Then he'd dive into the stage of development. Have they launched a product? Are they generating revenue?
Mm-hmm.
If not, it's another pass.
So he's weeding out the companies that are still just an idea.
Exactly.
He wants to see tangible progress.
Right. And then he'd ask, what industry are they in? Does it align with his expertise in software?
Yep.
If it's biotech or hardware, for example, it's a pass.
He's sticking to his lane.
Exactly. Leveraging his knowledge and experience. But even within software, there are tons of companies. So that's where valuation comes in. If the company is raising money at a valuation above $25 million, post-money, it's a pass.
So there's a price limit. Why is that so important?
Well, remember, Matt's looking for those potential home run companies, the ones that could generate 100x returns. If the valuation's too high, the potential upside is limited.
Okay, makes sense. All right, so last filter on the checklist, pro rata rights.
That's right. He wants to make sure he has the option to maintain his ownership stake as the company grows.
Right.
And if the founders aren't willing to grant those rights, that's a red flag.
Wow, we've covered a lot of ground. It's incredible how each element of the thesis works together to help find those hidden gems in the startup world.
It really is. It's a powerful framework for making smart decisions and avoiding costly mistakes.
This has been incredibly insightful. We've gone from this vague concept of an investment thesis to understanding how it can actually guide decisions and lead to success in the world of angel investing.
And this is just the beginning. In part 2, we'll explore Matt Wilson's strategies for things like check size, capital deployment, and follow-on investments. So stay tuned.
Okay, sounds good. Welcome back. Last time we really started to uncover the secrets behind Matt Wilson's winning strategy.
Yeah, it's pretty fascinating.
Yeah, his investment thesis is like a laser-focused roadmap.
Yeah.
Guiding him towards those potentially game-changing companies.
Right. We talked about how he defines his sweet spot, those seed stage software companies in North America, and why that's so important for achieving those venture scale returns.
Exactly. But it's not just about finding the right companies. It's also about knowing how much to invest in each one.
Right. Oh, absolutely.
That's where things get kind of tricky.
Yeah, you've got limited capital, so many exciting opportunities. It's easy to get caught up in the hype. But Matt Wilson has a surprisingly counterintuitive approach to check size.
Okay, I'm intrigued. Spill the beans. What is it?
He recommends writing the same size check for each investment,
Wait, hold on. Really?
regardless of how strongly you feel about a particular company.
So even if he thinks a company has, like, unicorn potential,
Uh-huh.
he wouldn't invest more than he would in a company he's less excited about. That seems kind of, I don't know, illogical.
It might seem that way, but there's a method to his madness.
Okay.
By keeping his check size consistent, he avoids those emotional biases and treats each opportunity systematically.
So it's about, like, taking the emotion out of it
Yeah.
instead of getting swept up in the hype.
The next big thing, frenzy.
He sticks to a disciplined approach.
Exactly. Remember, angel investing is a long game. You're building a portfolio, not betting on a single horse.
Right. Okay, that makes sense. But if you're not letting excitement dictate check size, how do you determine the right amount to invest in each company then?
Well, Matt advises investors to think about their total capital allocation for angel investing over a specific time frame, let's say 4 years.
Okay.
And then he suggests dividing that amount evenly over the number of investments he plans to make during that period.
So instead of trying to time the market or chase hot trends, he's spreading his investments out
Yeah.
over time. Is there a name for that strategy?
He actually calls it time diversification.
Time diversification.
Yeah, it's kind of like dollar cost averaging, but for startups.
Okay.
By investing across multiple vintages of companies, meaning those founded in different years,
Uh-huh.
he reduces his risk and smooths out the ups and downs of the startup world.
It's like he's building a diversified portfolio. Not just in terms of companies, but also in terms of time.
Exactly.
That's pretty clever.
Mm.
All right, so we've got check size and time diversification covered. What about follow-on investments? How does he decide whether to, double down on a company that he's already backed?
Well, he really looks at 4 key factors:
Yeah.
revenue growth, valuation increases, investor participation, and team execution.
Okay, let's break those down. First up, revenue growth. What
Mhm.
kind of numbers is he looking for there?
He specifically mentions this 3T2D rule of thumb.
3T2D.
That means the company should be tripling revenue each year for the first 3 years,
Yep.
and then doubling revenue for the next 2. That's the kind of trajectory that gets investors excited.
Wow, that's serious growth.
It is, yeah.
But it's not just about growing for the sake of growing, right?
Right.
The valuation needs to kind of be justified as well.
Oh, absolutely. If the valuation's increasing faster than the revenue, that's a big red flag.
Okay.
Could mean that the company's getting ahead of itself, and the hype might not be sustainable.
Right, so it's not just about top-line growth. It's about sustainable growth that's reflected in the company's valuation.
Yeah.
What about investor participation? Why is that important to him?
Well, if other reputable investors are participating in subsequent funding rounds, that's a really strong vote of confidence.
It's like a stamp of approval.
Exactly. It means other experienced players have done their due diligence and they believe in the company.
So it's not just about your own assessment. You're also kind of looking for those external validation signals.
Exactly. And finally, there's team execution.
Okay.
This is always crucial for any startup, but especially as the company grows and faces new challenges.
So you're not just investing in a product, you're investing in a team.
Right. You're investing in their ability to execute, to adapt, and to overcome obstacles.
You want to see evidence that they're hitting those milestones,
Yeah.
attracting top talent, and making smart decisions.
Exactly.
Okay, we've covered a lot of ground here. Check size, time diversification, follow-on investments. It's amazing how each piece of his strategy fits together to create this, like a well-oiled machine.
Yeah, he's not just throwing money at startups. He's taking a calculated, strategic approach to building a portfolio.
Right.
A portfolio that has the potential to generate those outsized returns.
Welcome back to the final part of our angel investing deep dive.
Yeah, it's been a wild ride.
It has been. We've walked in the shoes of Matt Wilson,
Mm-hmm.
learned about his investment thesis, explored his strategies for picking companies, and even figured out how he decides how much to invest.
It's like we've unlocked the secrets.
Exactly. But, even if you aren't planning to become like the next Matt Wilson,
Yeah,
these insights are still super valuable.
absolutely.
I mean, just understanding how investors think
Right.
can make you a sharper entrepreneur or a savvier employee or even just like a more informed person.
Right.
Just about the business world in general.
It's like you're seeing it from a whole new perspective.
Exactly. It's like having X-ray vision for the world of startups,
Exactly.
seeing all the underlying mechanics.
Exactly.
So let's start by revisiting the concept of personal alignment.
Okay.
Going back to, the idea of playing to your strengths. Investing in those areas where you have a genuine passion and expertise.
Mm-hmm.
I get how that's crucial for like Matt, but how does that apply to like everyone else?
Well, it's all about making choices with intention. Instead of always chasing the latest trends or the highest salary, consider focusing on roles and industries that really excite you,
Right.
where you can use your unique skills and knowledge to have a genuine impact.
Yeah, so it's not just about like climbing the ladder, it's about finding the right ladder to climb in the first place.
Exactly. And if you find yourself on the wrong ladder,
Yeah.
don't be afraid to just jump off and find a new one. It's never too late to, to pivot, to change your career.
To find those opportunities that are a better fit.
Exactly.
I love that. It's about taking ownership of your own journey. Now let's talk about the power law.
Ah, yes.
The idea that just a small handful of investments,
Or efforts.
right, will drive the majority of your returns. I mean, this principle applies to, way beyond just finance.
Oh, absolutely.
So give us an example. How does that apply to, everyday life?
Well, think about your time management. Are you spreading yourself too thin, trying to do a million things at once? Or are you really focusing on the tasks that really matter?
The ones that are going to make the biggest difference.
Exactly. The ones that are going to move the needle.
So it's about prioritization, identifying those high leverage activities and really cutting out all the distractions.
It's about working smarter, not just harder.
Exactly.
Uh-huh.
Okay, and what about those pro rata rights?
Right.
The ability to double down on your investments as a company grows.
Well, this highlights the importance of, building those strong relationships,
Okay.
really demonstrating your commitment and going above and beyond.
Yeah, it's not just about showing up. It's about adding value,
Exactly.
earning trust.
Becoming that indispensable partner.
And, whether you're working with colleagues, clients, or even just, friends and family, those principles can really make a difference.
Absolutely.
So it's more than just like transactions.
Yeah.
It's about really building those genuine connections and being the kind of person that, other people want to invest in.
Exactly. Now let's go back to that question we asked earlier.
One about what kind of company we'd be excited to invest in.
Right. Have you given it any thought?
I have. I've been thinking about it, yeah.
Good. And don't limit yourself. Don't just think about, the existing companies or the industries that are out there now.
Okay.
Think big. Think bold.
Think about those problems in the world, the ones that aren't being solved, the opportunities that are just waiting to be seized.
What kind of company would you be proud to support? What kind of impact would you want to see?
That is a great question to ponder.
It is.
Because ultimately, the future isn't predetermined, right? It's shaped by the choices that we make,
Absolutely.
the ideas we champion, and the actions we take.
So go out there and create something amazing.
I love that. Whether you're building a company, investing in one, or just applying these principles to your own life, we believe in you.
We do.
We believe in your potential to make a difference. Thanks for joining us on this deep dive into the world of angel investing.
It's been so fun.
It has been. We've had a blast.
We hope you enjoyed it, and we'll see you on the next deep dive.
See you next time.